Hello and welcome to this week's edition of Mineweb.com's Gold Weekly podcast. My name is Jeff Candy, and joining me on the line is John Embry. He's the Chief Investment Strategist at Sprott Asset Management. John, it's been a little while since we chatted to you, and in some respects a lot's happened, and in some respects very little has actually really happened. But gold prices have come off fairly substantially from their highs in September last year, and now, however, they do seem to be picking up just a little bit as we get into the Chinese New Year and the Indian wedding season. How do you see the market placed at the moment?
Well, I thought that the takedown post-Labor Day was seriously overdone. I think that, with what was going on in the backdrop in Europe in particular, but throughout the world, there was nothing that I would say was gold unfriendly or silver unfriendly for that matter. And I think it was reflective of the power of the paper markets to sort of knock the price down much further than it should go. And what it's done is just accelerate the amount of physical buying around the world. I think the one thing we can discuss today is the power of the physical buying that's taking place virtually on each continent.
Well, let's look at that. And there are a few other issues I want to touch on as well. But if we look at the physical market first, I know there were some concerns, particularly in India, where we saw the rupee price of gold hold steady at fairly close to record highs going into the wedding season, that perhaps we might not see as much buying as we have, really.
Well, the rupee's been a bit weaker, and I think that certainly has influence, but the premiums in India are sufficient to suggest that there's still good buying there. I'm more interested particularly in the buying that's going on in China and in Europe. You saw a number that what the imports via Hong Kong into China for the last, I think it was December last year, they were about 100 tons. You think about that, this is only about a 4,000-ton market, and in 1 month, the Chinese imported 100 tons. That's huge. They've been pretty, forthright about saying, expressing their views on gold and other things, and now they're taking action. And as a result of, I'm told by friends of mine who sort of deal in that market in Europe that the demand is equally robust for physical gold in that market, and is particularly accelerated since the new year began.
Well, I suppose, and understandably so, given the macroeconomic conditions in Europe, and as we continue to see the uncertainty regarding the sovereign debt crisis in the region.
Well, you're right. Europe's a pretty obvious one, but if you look closely at the United States, and everybody's so focused on Europe at this time that they're kind of giving the U.S. a free pass. They're no picnic either. Basically, I think the last I looked, they're running up debt at about $1.8 trillion a year. That's humongous. Just think about it. If you go back to when Ronald Reagan was elected president, the total gross funded debt of the United States was $907 billion. Chalking that up in a 6-month period now. That is preposterous.
John, if we look at what went on over the course of the last 3 months of 2011, there was a fairly substantial fall-off in gold prices and indeed precious metals in general. Were there any other factors that drove that other than concerns around what was going on and whether or not we'd just gotten a little bit too hot?
Well, I think it's a very significant exogenous factor, and that was the spectacular failure of MF Global. Essentially at this point, they don't seem to know what happened to $1.2 billion worth of client money, and a lot of that money was earmarked for sort of investing in the commodity markets, particularly in gold and silver. And I think a lot of accounts got frozen. So I believe that had a very negative impact in the short term on the price of gold and silver. And now this is ameliorating now, so things will get better. But I don't think you can underestimate that.
The U.S. is an area I want to come back to. But if we look briefly at China first, and particularly the impact or perhaps the likely impact of this Pan-Asian gold exchange, given how much physical gold buying is happening in China and the scope of that market, are we likely to see increasingly the Chinese not only buying gold, but the Chinese population coming in and buying gold as well?
Well, that's been a key underpinning of my belief that, the Chinese government has encouraged their citizens to buy gold. They're setting up, they mentioned the Pan-Asian Gold Exchange, which is still just barely getting off the ground as far as I understand. But it'll be a game changer because it's going to be much more physically based than, say, the COMEX and the LBA. And as you know, the COMEX and the LBMA are so hot, it's our fractional gold trading to the extreme. And in some ways, they siphon off a lot of natural buying. I mean, the Chinese could change that equation by having a much more gold-centric exchange in there.
In terms of, if we look at the COMEX in particular, and perhaps look at the CFTC regulations that were supposed to come into effect on January 17th with the Dodd-Frank Act, has that happened? Are we likely to see any changes in terms of the way in which gold is traded in the U.S.?
Well, as far as I know, those were postponed for another few months. I mean, this seems to be, a never-ending saga. They're going to do something about position limits, and then nothing happens. No, I don't think. I'm not counting on that as being major development helping the gold market. I think the buyers themselves will have to sort of be the catalysts, and they will have to basically demand delivery of physical gold, which essentially isn't there. Now, whether that happens, we remain subpoenaed. It hasn't happened yet.
In terms of the demand side of the market, clearly central banks played a fairly large role over the course of 2010 and indeed 2011. Are we likely to see this continuing in 2012?
Well, I would expect so. I mean, basically, I think the Western central banks, who for about 15 years plus supplied massive quantities of gold to the market, are probably reaching the limits where they don't really have much left that they want to part with. And they're unquestionably Eastern central banks. I mean, there's all sorts of countries in that part of the world, and in the Middle East for that matter, who are afloat in U.S. dollars, and basically they are converting some of them into gold. So last year, the number the GFMS used was like 430 tons, I think, central banks accumulated. That's an enormous change, and it puts a lot of stress on the physical market, because that same source, the central banks in general, have been major suppliers of gold. And, the amount of gold coming out of the ground isn't changing much. I mean, there's been a little more scrap, but I think the physical market's tightening at a very rapid rate.
John, we've had some comments from a variety of sources. The most recent, I think, was GFMS, who said, yes, gold prices are going to continue going up, but if we see a turnaround in financial markets, probably in 2013, and we see real interest rates going back into positive territory, for example, we're likely to see a dip or sort of a change or a reversal in the secular bull market in gold. What is your view of that? Are we likely to see that happening?
That was probably the most awesomely stupid statement I have read in the last 6 months. I don't know what these guys are thinking. The chances of there being an improvement in financial situation in the world that will allow real interest rates to turn positive is zero. And when these guys persist in this crap, it makes me angry. That's my opinion.
It's definitely a valid one. I suppose, John, the question then becomes, what does that mean for the gold market if we're unlikely to see real interest rates in positive territory anytime soon? Or what timeline are we now dealing with, do you think?
Well, I think what you're going to see, Jeff, to the contrary of what GFMS seems to think, is that there's no solution to these debt problems. There's an excess debt issue in virtually every country of any import in the world. The chances of growing out of it are zero. I mean, I'm a big believer in Austrian economics. And yet the growth requires more and more debt creation. We can't support the debt we got already. We've seen that in vivid fashion in Europe. So consequently, I mean, I'm a believer in the great expression that my friend Jim Sinclair coined a few years ago, quantitative easing to infinity. And I think that's basically the easiest way for the powers that be to go, because nobody wants to be on the watch when the thing implodes. And what will essentially prevent implosion is just more and more money creation on a global basis. And I see sort of a global Weimar in the future. So yeah, I'm very bullish on gold as a result of that.
I mean, clearly it is very much a case of be careful what you wish for, though, because that doesn't paint a particularly exciting.
I don't want this to happen. Don't get me wrong.
Sure.
I mean, I just said we've gotten ourselves in a position that basically there's no middle ground anymore. Either there's going to be a hard deflation if we don't continue to sort of support the debt in the system, and the only way to support the debt is to create more and more paper, which has its own negative implications, which is mounting inflation down the road. So, no, I mean, we've made our bed, now we got to sleep in it.
If we look briefly at gold in relation to some of the other precious metals, silver's been trading fairly well over the last few weeks, and indeed gold is trading at a much higher level than platinum, and has been for most of this year, really, which is an unusual thing to happen. Should you be watching those kinds of ratios?
Well, that's interesting you bring that up. It's not unusual. The unusual point in history was when platinum was trading at a massive premium to gold. And now that we're in something of an ongoing financial crisis, if you go back in history, the relationship between gold and platinum, gold always traded at a massive premium to platinum under those circumstances. Platinum isn't a monetary metal. And as a result, I think the spreads in gold and platinum will widen dramatically. And I think the best of all of the metals, silver, because it's going to become poor man's gold as the gold price rises. More and more individuals, will be squeezed out of that market, and they will have to sort of get their protection in silver. Silver market's very tiny, and it has tremendous industrial and growing industrial demand and solar panels and electronic applications, medical applications. I think the silver market's spectacular. We absolutely love silver here at Sprott, and I wouldn't be surprised to see it double in the next year.
John, just to close off with, then, if we look and coming sort of full circle to the demand side again, into physical demand, are there any perhaps hurdles on the horizon or clouds on the horizon that could see this physical demand come off?
Well, I think GFMS referred to one, which I don't think will happen, and that is sort of an improvement in the financial and economic situation that will allow things to return more to normal. I think that, as I've already stated, that as you go forward, it will require more and more money creation at zero-based interest rate in a zero-based interest rate environment. And under that scenario, you can't own enough precious metals.
Do you think, if we look ahead now to the rest of 2012, how do you see the price of gold playing out?
Well, I would be very surprised if we didn't move through the all-time high, which was something in the neighborhood of 1900. And we'll just have to see how things unfold. I mean, if the economies are as damaged as I think they are, and particularly in Europe, and I don't think they're as good in China or the U.S. as they're trying to crack them up to be. These require sort of loosening in the quantitative easing of various fashions. And I already starting to loosen up in China. These are all very bullish things for the gold and silver market. And under that scenario, I think the gold and silver prices could conceivably up their biggest percentage gains this year that they've had in the entire bull market that started 11 years ago. I mean, gold has never risen more than about 35-36% in 1 year in that 11-year time frame, but it has gone up on a yearly basis every time. I don't think it ever happened in a significant commodity before. 11 consecutive years of higher closing prices. I think this will be maybe the best year of the 12.
I suppose the big question is whether or not, or how many years left after that we have.
Well, if more than most people realize, this could come very quickly because hyperinflation is the thief in the night. It just sneaks up on you. Right now, everybody seems to think that unlimited money printing, because we haven't seen the inflationary impact, because the economy's a bit soft, can't happen. But hyperinflation is a currency event. It isn't an economic event, and I think that's where we're headed. I think we're headed for a meltdown of the fiat currency system. That has amazingly positive implications for gold and silver.
John Embry is the Chief Investment Strategist at Sprott Asset Management, and that's it for this week's edition of Mineweb.com's Gold Weekly podcast. From me, Jeff Candy, thanks for listening, and please join us again next week.